So how does fintech work in practice? My name is Tilman Ehrbeck. I am the co-founder and managing partner of a fintech venture capital firm called Flourish Ventures. Over the past 10-12 years, we have invested in some 80 fintechs. And for every investment, we look at least 50 or even more companies. So my firm probably has looked at 4,000 or 5,000 fintech entrepreneurs and their ideas. And I will comment a bit on the practical reality of fintech, the promise and the reality. And I will do this across the 2-3 big waves of fintech that we have seen over the last 15 years or so. So the first wave started really with the financial crisis, and it was fueled by 3 elements. First, the incumbent financial sector players were retreating and constrained from innovating because of the crisis. There was a lot of capital available, interest rates were low, a lot of risk capital flushing around. And third, we had a once-in-a-generation technology innovation, namely the smartphone, or the mobile phone first and then the smartphone. So a number of the early innovations in the first wave were business-to-consumer type innovations. And the idea was we can use the phone and technology to deliver far better services at far lower cost to more people. How has that worked out? The evidence is somewhat mixed. There are some real success stories. For example, challenger banks. We invested in a company called Chime in the US. US retail banks were not treating their customers very well at the time. They would require minimum balances. They would not credit people with their paycheck when it got in. They would sit on the float for a couple of days. And most annoyingly, they would charge a lot of fees, punitive fees, overdraft fees, for example, $35 per instance. And so we felt that is really not necessary. The challenger banks over time became very successful. Chime has 15 million users. Their accounts are free. They credit their customers with their paycheck the day it comes in. And most importantly, they don't charge overdraft fees because they don't let you overcharge. And over time, these challenger banks put pressure on the incumbents, and the incumbents started mimicking the features. The Consumer Financial Protection Bureau in the US estimates that in 2019, US households paid some 12 billion in punitive fees, overdraft fees. In 2024, they redid this data. It's reduced to 5 billion. So there's a real impact. Challenger banks have made people's lives better. So that's a success story. But there are also things that did not pan out. You might remember digital wealth management, robo-advisors. In the end, that turned out to be a feature. It's not a business model. It's very hard to build an asset management business. It's a scale game. So some of these robo-advisors are still around, but they are really teeny and are not relevant in the broader asset management space. So mixed story in this first wave. The second wave of fintech innovation was more focused on business to business, much less hype, much more focus on viable business models. And they were premised on 2 ideas. The first one is there's a lot of platforms out there that actually are important in people's daily lives. Digital platforms, non-financial platforms. And they have advantages. They have much lower customer acquisition cost, they have very high customer engagement, and they generate proprietary data that's valuable from an underwriting perspective, either for credit or insurance. But these non-financial platforms, that's the second premise, don't want to necessarily be regulated as financial sector players. So they need a modern B2B fintech infrastructure, cloud-based, API-based, to connect to regulated balance sheets or the capital markets. So twin hypothesis, The first one goes under the moniker of embedded finance and then modern B2B fintech infrastructure to support that type of embedded finance. And here the jury is still out on embedded finance. Some important experiments have not worked out. The big techs probably are much more focused on their core businesses and the challenges to their core businesses. But then there's a whole wave of what we call vertical SaaS. That's software companies that embed in the workflows of small businesses. There's Toast, for example, for restaurants. And what they do is they help with staffing, and they do help with payments, of course. And once you do all that, you have a sense of the underlying business, and you can actually offer credit and underwrite working capital credit in a way a traditional bank could never do. So embedded finance, the jury is out. On the infrastructure side, the B2B infrastructure, we have seen enormous progress. There's a whole host of modern players that are replacing the incumbent technology players, and they do things much, much cheaper, often 70–80% cheaper than in the past, and much, much more faster. So today, you can launch a new financial product as a plug-in within weeks, and it used to take months, if not years, to build all the infrastructure connections. So we have seen a lot of success in the B2B infrastructure space. Is there a third wave? Hard to discern. Blockchain, we don't see so many useful or use cases, meaningful use cases yet, except for maybe stable coins in the cross-border payment space. Gen AI is a very powerful technology, but limited in financial services so far. Actually, machine learning has done a good job for underwriting and other pieces already. We will probably see fraud, right? Gen AI will enable fraudsters to even better impersonate and coordinate their phishing attacks. And there's an arms race between the fraudsters and the folks who are trying to use Gen AI to detect them. So we are in for an interesting time. Fintech is here to stay. It has promise. Be aware of the hype and focus on those business cases where there is true value created for all parties involved, the customer, the provider, the new intermediary. And that would be my practitioner's perspective for today.